Here's an alternative asset you probably didn't know about: guns. Gun prices have been going up. Gun sales have been going up. Why is that? We'll be talking about this and the other two assets that Tom Luongo covers: goats and gold. Tom is the author of the newsletter entitled Gold, Goats, and Guns. Pleasure to have you on the show, Tom. First time on Kitco. Welcome.
Thank you, David, for the invite. Appreciate it.
Alternative assets is the theme of our discussion today, and you are an expert on the three things that encapsulate the name of your newsletter. We're going to start by talking about guns. Like I said in the beginning, the introduction, gun sales, gun prices have both been going up. Let's start by talking about some statistics. So the producer price index by industry, small arms, data from the St. Louis Fed, that's been trickling up ever since 2017. We saw a dramatic rise in 2019 and then another rise yet again in 2021. According to this index, if you consider that 100 is the baseline of 2014, it's gone up about 6% since 2014, a steady increase in the price of firearms. Now, closer to Canada, where I'm from, I'm just going to read the story here. Gun imports in 2021 have been the second highest year on record since 1988. The reasons. So first of all, almost every gun in Canada is imported, but some of the sources of this increase: shotguns from Italy went up, rifles from Finland went up, handguns from the Czech Republic went up, and of course, in terms of imports, the USA accounts for 42% of all Canadian gun imports, the highest country of origin. The broader question is why? Why are people buying so many guns, or have been buying so many guns and ammo over the last 2 years? Let's start with that.
Well, I want to congratulate I really want to congratulate you Canadians on your taste in handguns. I'm a huge fan of Czech handguns. As a matter of fact, I'm a huge fan of CZs. Just had to get it out there. I saw that. I'm like, ooh, that's good. Very good. You guys have good taste in handguns. So why is this happening? Well, we're entering a phase of sincere institutional collapse at a certain level, and sincere institutional at a minimum unrest, right? And when those things happen, and then invariably, and people's anxiety rises, and the first thing they do is they think in terms of personal protection. So, and of course, it never hurts that we also have a hostile regulatory environment. I know it's been an issue in Canada, the potential for outright ban on guns. I know the Democrats continually make it an issue every couple of election cycles, and so that's part of the reason why.
Okay, it's interesting because it's not just sales, but it's interest in guns as well. In the U.S., for example, I'm looking at the statistic: number of background checks performed by the National Instant Criminal Background Check system in the U.S. from 1998 to 2021. Again, second highest year on record in 2021. More people are probably applying for guns in the U.S. Now, this is another interesting story from the New York Times. This was dated 2 years ago. But the headline is about 2 million guns were sold in the U.S. as virus fear spread. If you look at this chart that they've put up, the New York Times, again, this story was dated 2 years ago, but they've outlined gun sales over the last 20 years, and you see spikes whenever you had domestic violence, or you see periods of domestic turmoil. So in 2023, you had 2 million guns sold after Obama's reelection and the Sandy Hook shooting. In 2009, 1.1 million guns sold the month of Obama's election, a huge spike. And September 11th, another huge spike, 754,000 guns. This chart illustrates that whenever you have domestic turbulence or geopolitical turbulence, you have a rise in fear and a rise in gun sales. So my question to you, Tom, is: do you see, if you assume that guns are a good long-term investment, do you then also assume that domestic turbulence or violence or any sort of disruption will potentially tick up in the future?
Well, I think that's kind of the base case, given the situation. I've been saying this for a while. We're dealing with the twin problems of inflation and rising taxation, of a loss of institutional confidence, which is going to fold into the gold discussion as we move forward. So, yeah, when you see the headlines are rising civil unrest, when you see people are having a hard time putting food on the table, or making ends meet, or whatever, it's just the natural consequence of what happens, that they're going to want to protect themselves. Store owners are going to want to protect themselves, or or households. And as far as guns as a long-term investment, I've always thought that between that and the inevitable continual restriction on gun ownership, right?
Okay.
The same way that gold was, driven underground. Well, guns are going to be driven underground. And when you drive something underground, you're going to create a black market for them. And then obviously, value thereof is going to go up and all the rest of it. So, I mean, I've got guns that I bought 20 years ago that I know that I bought for, $100 or $200. And I know I could sell for unbelievable amounts of money today because of, relatively speaking, because of the changes in import laws or regulations or whatever.
It's people probably buy firearms for a lot of reasons: hunting, personal protection, whatever the case may be. Now, I'm not advocating for more gun sales. That's not what I'm doing on here right now. But what I am curious to know more about, Tom, is whether or not a layman could just buy a gun purely as an investment, purely for investment purposes. I mean, is there a market for this? Can I just buy a shotgun and hold it for 10 years in my locker, and then in 10 years later expect to sell more? Can I do that?
I never thought of it in those terms, right?
Okay.
I've never, I advocate for people to buy more guns because I think guns are the ultimate check on government overreach. And your own, I believe in you should be your own, no matter what it is. You should be your own protection services. You should be your own investor. You should be your own central bank, yada, yada, yada. So, and guns are just another expression of that, a thing that you hope you don't need. It's an insurance policy. It's a thing you hope you don't need, but you should have. Now, if that insurance policy is able to pay off either by protecting your home and you unfortunately have to use it, or that you can, when you no longer feel like you need it or your circumstances change, you can then sell it into the marketplace, possibly for a profit. Well, that's the thing. I'm going to say this. You're not going to lose money on your guns. I don't think I've ever seen, other than unless you shoot it regularly and you wear it out, right? Unless you have a favorite pistol you take to the range and put 100 rounds through every week. Like, if you're like most people, you train every once in a while. You go to the range every once in a while. You remind yourself you learn how to shoot, and then you just re-up every once in a while.
Well, why would the price?
Your guns aren't wearing out, so they're going to hold their value.
Why would the price hold its value, though? I mean, when you think about the U.S. is the country with the largest number of guns per capita, you would expect supply to keep up with demand and, equalize it. But is that not happening?
It's the same reason why people hodl gold and Bitcoin. Right? It's the same argument. Like, and a lot of people just buy guns because they like guns. People, I have a collection of guitars behind me because I like guitars or you see basses. I like them. Right? People buy guns because they're cool. People like guns because it's another thing to collect. Some people collect stamps. Some people collect firearms. At an earlier portion of my life, I would have probably, I did. Like, I had a whole list. I remember a ridiculously unrealistic list of guns that I wanted to own.
What's interesting?
And I get pictures from people all the time. Like, dude, did you see what I just got? I'm like, oh, it's beautiful. And we do the same thing. So,
what's interesting, Tom? I'm looking at ammo prices. So I'm going on ammopricesnow.com. 9mm ammo, 223 Remington, 12 gauge. All of those things have gone down in price. So 9mm, for example, peaked in 2021. Same with the 12 gauge. Same with the 223 Remington. Actually, the 12 gauge has been relatively flat since 2021. My point is, ammo prices have come down while gun prices have gone up. Why the disparity?
Because we just went through a massive, massive shortage of ammunition in 2020, 2021. People had guns, but they didn't have enough ammo. Like, I went to gun stores, and all during 2020, I bought a handful of guns during 2020. And of course, I wanted to buy ammo along with it. And people were worried about things. It's one thing to have a gun. It's another thing if you can't feed it. If you have all these newly minted gun owners that are going to go out and buy a new gun, you have to buy a few hundred rounds of ammo to train with it and everything else. And that ammo is consumed. We have also had regulatory curtailment of ammo production in the United States. Obama, was categorically trying to get rid of all lead smelting in the United States during his 2 terms of presidency, or now doing the same thing in his third. So up and down, ammo prices are going to go up and down based on just acute supply and demand shortages and mismatches during the and that's what happened during then. And then today, I'm thankfully ammo prices are down, but they're nowhere near where they were 20 years ago. Like, the better investment than guns has actually been ammo. Like, I used to be able to get, 9mm for, 9 cents a round. You can't touch it today for less than 50. And during the height of it, it was $1 a round. I'm like, dollar a round is like, that's hunting rifle, prices for ammunition. And that's how acute the shortage was. So, 2021 is not a particularly good baseline to talk about, what ammo prices should or should not be.
I see.
So,
Okay, so long term, you still made more money on your ammo. Okay, well,
probably.
Tom, for people who may not want to buy a gun for themselves, but still want to be exposed to the firearms industry because maybe they agree with you, maybe they think it's a good long-term investment, are there other avenues they can take?
Well, I mean, you've only got a couple of publicly traded gun producers on the market, really. And, as U.S. investors or as North American investors, you've got Sturm Ruger and you've got Smith & Wesson brands. Those are your options. And, pick one. They're both reasonably well-run companies. I think Smith & Wesson has, had more upside during 2020, but they're both reasonably good companies. They both trade at very low multiples, and they both pay a nominally, they both pay a nominal yield about 2% or something like that. So they're not great investments, but they're very volatile. The best thing to do with them is to buy them when no one is interested in guns, like everything else. When the market is uninterested in a particular topic, you should be buying it, and when everybody gets interested in it, you should be selling. And then you just and then you book the spread trade, and it may take a year or 18 months or 2 years for a particular thing. Investment like that to pay off, but something like Smith & Wesson like exploded from like $8 to $20 a share over like a 3-month period. So because they couldn't keep guns in stock. So,
all right, final question on firearms, and I'll move on to the other asset classes. Do you think there's going to be changes in regulations in the U.S. that might either change sales volumes or affect people's consumption patterns or affect supply?
Once the Democrats are out of office, it's probably not going to be as big a deal. It's not going to be as good a trade. It's going to be the time to accumulate gun stocks as opposed to on the way down. I don't think they're going to be giving you explosive returns. Gun sales and gun stocks always do well whenever the Democrats take power, because they're always talking about wanting to get rid of them. Biden administration is going to continues to try and make it a political issue. It's not flying. No one's listening to them. Sales amongst gun sales amongst minorities, from what I saw very briefly, they're through the roof. Like, it's just everybody's feeling the pinch and everybody's worried, and when the division of labor contracts, your tribes get smaller. When your tribes get smaller, those you trust get smaller, and therefore you're just gonna you're gonna look after yourself and not really think. You're gonna think locally, and you're not gonna care about globally. So
yeah,
I would discount. I would not think much about gun control regulation in the United States fueling, panic gun sales for the foreseeable future after the midterms.
Okay, so you think it's a supply issue? The administration in power is limiting production. That's going to have a positive impact on prices.
Well, I just think that that's generally what happens. Like the Democrats come into power and they always talk gun control, and then because they're commies. Sorry, but they are. And, that's what they do. And then they scare everybody. Gun sales go through the roof. Ammo shortages occur. And then and then the Republicans block it. Everybody realizes that it's a bad issue. The Democrats fundraise on it 9 months away from the election. But when it comes down the pike, it comes down to election day, they all say the same thing. And we're not going to get rid of your guns. We're not going to take your guns away from you, because they know they can't win on it. It's a losing issue. It's been a losing issue in the United States for 70 years. It's a good fundraising issue, but that's about all it's good for. So play this and just play the trade if you can.
All right. Well, let's move on to the second part of your newsletter, goats. We're not going to talk about goats in particular, but cattle, livestock and farmland. So live cattle, actually, the prices, I'm looking at live cattle prices, like most commodities, come down a little bit in the year, but actually recently, as of 2 months ago, live cattle prices have been going up. If you want to measure it from a dollars per pound basis, is that something you've observed? Is that cattle prices have been going up recently?
Meat prices in general have been going up, and the problem is that the producers aren't really getting paid for them. If you look at the futures price on cattle futures prices and whatnot, they're terribly depressed, because what we're having now is, with feed prices being where they are, and feed prices being, even with grain prices like practically halving over where they were earlier, a year ago. Like wheat's back down to $8 a bushel from 13. Oats are down from 750 back down into the mid fours. Soybeans are still 14, but the soybeans aren't really used heavily in animal feed. Mostly corn, oats when necessary, and wheat midlands, things like that. So those are input costs. to animals. Like those are your biggest input costs in finishing an animal and getting it to the market. And if a rancher cannot finish his cattle properly, he's going to start culling his herds. And so we have the meat trade is not a simple thing to understand because there's timing involved in what happens in the waves of herd destruction and the handicapping that the market does relative to that, the future forecasting market does relative to that. Pigs are a little easier to forecast because in general, the replacement time on pigs is a lot faster. You can slaughter an entire generation of pigs and you can get them all back within a year. Cows are a 6-year cycle. People don't understand that when you slaughter a heifer, it takes 6 years to replace her. So we have a structural problem in the price of meat and the price of beef going forward. But, but at any day to day, what's happening, or any season to season, it could be, you can see a lot of counter trend rallies or a lot of counter trend moves in beef.
Structural problem. So what are you saying, Tom? Long term, then, I think people want to know whether or not their beef and veal prices in the grocery stores are going to go up long term.
I'm saying beef prices are going to go much higher than where they currently are.
Wow.
Oh yeah. No, absolutely. I don't see it getting any easier. I don't see anything changing. Do you see anything on the regulatory front from these crazy people in Europe and Ottawa and DC from trying to stop people from owning? They all want to see bugs now.
I bring up cattle.
That's what they're going, and like they're trying to take our cattle herds away from us. It's not hard.
I bring up cattle because it's interesting because now if you look up the United Nations Food Food Organization, they have a chart on where food prices have been going, or the underlying commodities and the food price index. So a basket of commodities that comprise of agricultural commodities, that's been going down 3 months in a row. So things like barley, wheat, those have been going down.
Sure.
Cattle, though, has been going up. So that, you've explained why. I just find this divergence very interesting, how you've got meat prices going up and the rest of the agriculture industry going down. Yeah.
Yeah, but short-term divergences like this are when you had prices literally double over an 8-month period, they don't mean anything. Like the bigger issue is we are now in a new pricing regime for wheat, as opposed to $3 or $4 a bushel. We're now talking $8 is the new baseline. Corn, it's no longer $3 to $4 a bushel. It's now $6 to $7. Oats used to be a categoric sell at $3 a bushel. Like if you were in oat futures and you were long at $3 a bushel, you were an idiot. Today, we're corrected to $4.50. We've corrected to $4.50. So I can tell you from having just gone to my feed store to buy feed for my ducks, my goats, my dogs, like the price on goat feed is $22 a bag. It used to be $8. When I got into when I bought my first herd of goats back in 2010. Okay. Cheap hay is $8 a bushel. It used to be $3. Okay. Everything is going up. And the futures price does not accurately represent what actually happens on a day-to-day basis. We know this in the spot gold market. We know this. We know this. And the same thing happens in almost all commodity markets. These futures markets are mostly broken. And it's not just in gold and silver. It's been in it's actually worse in things like meat futures and grain futures, far worse. And it's been a fundamental problem of this ridiculous central bank fiat money regime, which creates the incentive to grind all the arbitrage out from the producer and hand it to the financier and to the speculator.
Hey, Tom, how do you feel about
endemic across all markets?
Tom, how do you feel about synthetic meats? Do you think synthetic beef could one day replace cattle and then bring down food prices or cattle prices, beef prices?
I don't even want to discuss it from that perspective. Synthetic meat is an abomination.
Okay.
I'm not eating bugs. We don't need to do any of those things.
Well, I'm not talking about bugs.
Will they try and create a market for it? Absolutely. Will they try and create a market for it? They created a market for carbon futures. They can create a market for synthetic meat. But you shouldn't eat it. Like it's frankenfood. You shouldn't eat it. So will it bring food prices down? I don't even like to entertain. Like that's just giving them the argument. Like I don't want to do that. Like I just think that's not. We can farm. We've been farming cattle for thousands of years. We know how to do it. We do it very well.
There's a lot of
have to like. We don't have
There's
to
a
grow
lot
it in
of
vats.
ESG pressure on going on all over the world right now. You see it with the Dutch farmers, for example. Their fertilizers restrictions by the government. They're protesting. My point is, a lot of lobbyists are arguing that meat consumption is hurting the environment, and therefore we should consume less meat, and people might have fewer cattle in the future. Tell us about this trend.
I think it's all designed to have more control over the food supply than it is anything else. It's pure political agenda. That's all it is. And again, an ESG is the thing, and an ESG as an investment theme has already peaked. BlackRock went all in on ESG, and they're getting gutted. Vanguard's the same way. They're losing AUM, assets under management, quarter over quarter. I think BlackRock's now into 3/4 over quarter that they've lost assets under management because they can't make any money on ESG based investments. Okay, so what's happening in the Netherlands is a pure power play to destroy the food production in the Netherlands. The farmers have there's absolutely no reason why they have to cut
of all industries. Why would the government try to destroy the food supply? Like, why would they do that?
Because they believe in this stupid global warming stuff that cow farts matter, and that cow farts create global warming. And so we want to grow this stuff under air conditioning in vats or something, and they want us to farm crickets because it's more efficient, and we need to eat cricket protein. That's what they're going for.
So you deny
literally what they're saying to us.
So you deny any evidence that methane created from cows and cattle farming create global warming.
Absolutely. The volcanic activity has always pumped far more CO2. Not that I even believe that CO2 is a driver of global warming. I think that entire narrative is nothing more than a narrative. I always have. I always will. I've looked at the data. It's the temperature data is nonsense. The whole theory is nonsense. It's just pure politics.
All right. Well, there are scientists who might argue otherwise, but we're here to get your opinion, so we can probably have this debate at another time. I want to talk about farmland now. Farmland is another interesting asset class. I'm looking at statistics. This is just farmland in Canada. In 2019, farmland went up overall on an aggregate basis in Canada, 5.2%. In 2020, 5.4%. It just seems to be growing steadily despite other asset classes being volatile. Would you make the argument that farmland is a good diversifier to your portfolio?
Oh, absolutely. I like farmland. I like farmland and timberland. I've been recommending timber REITs to people for years. I like timber REITs because they're easy. Unlike gold miners, you don't have to sell your carrying costs are so low and your energy costs are so low that if stumpage prices are down, you just let your trees grow another 8% next year and then harvest them next year. If you're not under any pressure to sell your product into the market, like most extractive industries are, where they're constantly on that financing treadmill, on that high cost of goods sold, low margin treadmill, then I love timber. And farming is very, very similar to that. But farmland is a good investment. It is. And it's been for a while now. I have a couple of stocks I really like in that sector.
Actually, before we move on, I'm just one question about cattle. Again, investment plays. How do you buy just cattle futures? How do you invest in this space?
Oh, there's not a lot. Like there's mostly the indexes, and there's a few ETNs out there.
Right.
Like there's cow, the agricultural livestock index, ETN, like ticker symbol cow.
Okay.
Like you can buy meat.
So
you can buy a broad. It just tracks the Bloomberg livestock agricultural index. So you could buy that one.
Okay. Well, and again, on the agriculture side, you could buy a farmland, but or plot a farm, but you can't. Other instruments you can buy.
There are good farmland REITs that are out there.
Right.
And farmland companies, there's a few, and not a lot. These are not particularly, especially at the public space, the public level. There's lots of private equity stuff. Like most of your good timberland investments are all private equity. But if you look through the NCREIF data on the annualized returns, the timberland generally, slightly outpaces the S&P 500 over a 40-year period. I mean, if you want a fire and forget style investment portfolio, I love timber, but you've got to you've got to know most of those investment opportunities are in private equity. And I imagine the farmland's a similar thing, but there are a few good farmland style REITs that are out there.
Okay.
So there's not a lot, but there's a few. And same thing in timber. There's only a couple.
All right. So farmland REITs, we'll look into those. And finally, let's talk about gold. This is an asset class that we've discussed countless times on our show at Kitco. Now, you've said earlier in the interview that you should buy guns for the same purpose, for the same reason, rather, that you should buy gold and Bitcoin. Can you elaborate on that point?
Sure. It's just insurance. Like the main reason you add gold to your portfolio because you need insurance against a loss of purchasing power of your in this case, dollar-based assets, or Canadian dollar-based assets, or euro dollar assets, or whatever, euro assets, or whatever. The same thing with Bitcoin. Bitcoin is also a hard currency in that respect, in that it can easily form a relatively stable denominator. I know it sounds weird talking about Bitcoin in terms of stability, but it's still in its a tremendous growth phase in terms of total addressable market. So its volatility is very high because there's also not a whole lot of supply.
Yes.
And the same thing with guns. You're buying guns as an insurance against your tangible assets, against somebody stealing them from you. Well, inflation is also theft, right? It's theft over time. It's theft of purchasing power over time. So that's why you're supposed to buy gold. Now, I'm not necessarily I don't believe in gold as any kind of short-term or medium-term inflation hedge. It's always thinking in terms of a long time frame. You should always be buying gold when it's incredibly cheap, and you should not buy it when it's expensive. It's a trade like everything else, but it also forms the core of your investment portfolio or your savings portfolio. I see gold, Bitcoin as savings first, somewhat insurance, but it's really savings. And then you go and buy other investments. Once you have enough of those things that you've saved, that you have enough assets to make sure that you can eat if you lose your job or whatever, that's when you can start then thinking in terms of investing. And this is basic, this is basic Robinson Crusoe, economic analysis. You're not going to build a house until you have enough food for tomorrow to build while you're saved in order to build the house tomorrow. Like, you're not going to do this, right? And it's the same thing. We make the argument that we have to go into debt first in order to do any industry. That's wrong. Sure. You can either save through equity or you can buy debt, one or the other, but you're buying debt from somebody else's savings. Someone had to save first. And that's what gold is. I think that's what Bitcoin will eventually wind up being. And then both of them are a hedge against institutional disorder.
Okay. Let's touch on your argument that gold has stored your wealth over time and caught up with inflation over time, over the long-term horizon. You're right, it has. But some people might argue that there are other assets that have done the exact same thing, if not better. The stock index, for example, S&P 500 over time has also outperformed inflation. Bitcoin maximalists would argue that Bitcoin is the ultimate inflation hedge because look at the price performance since not even, inception, just since the last 5 years. So if you were to compare Bitcoin versus gold as an inflation hedge, just from an inflation hedge perspective, which asset is superior?
I can't really talk in those terms because they are addressing different markets. The markets are more complex than that, right? So do I think the Bitcoin maxis are arguing that Bitcoin is going to replace all other currencies, and therefore eventually we'll go from a total addressable market of maybe a couple 100 million people to 7 billion people, and so the sky is the limit. And 5 years ago, the total addressable market in Bitcoin was maybe 5 million people or 10 million people, and so therefore we get a massive rise in price against a shrinking inflation rate, against a falling stock to flow ratio. Gold is already considered money. Gold is already at its optimal stock. Whether or not you're going to have a wider total addressable market in gold going forward as people lose faith and the confidence in their debt-based fiat government-issued script, for lack of a better term, the dollar, the euro, the yen, with the pound. That's the bigger question. Gold is literally at its lowest total addressable market. I think it's probably that it's been in 4,000 years. And now the question is it going to be allowed to balance the books relative to central bank balance sheets And if it does, because it's either that or the end of the central banks, because if they don't do that, then Bitcoin's going to win. And so they're going to have to let it rise at some point. And when gold rises this time, it's going to be explosive. It's going to be the same kind of explosive as it was from 2001 to 2011.
How explosive?
And from 1975 to 1980.
How explosive, Tom? Do you have a target in mind that makes sense to you?
Yeah, somewhere between $7,000 and $15,000 an ounce. Because I think that there's a lot more gold in reserves that's out there than we've seen. I may be wrong. I may be being very conservative here, but there's also other avenues here, because there's other competing currencies that are going to fill in some of these gaps. And I'm specifically thinking of the Chinese yuan and the Russian ruble in the long-term sense. And I'm talking now 10 years from now. Yeah. Okay. Same thing when I'm talking about Bitcoin being a much more adopted medium of exchange the current architecture is unsustainable, but it's also not going to go away completely. Okay. And so we have to be very careful how we gauge what we're going to see going forward. I know what the number is today. We can do the denominator, the division as to how much money they printed and how much gold we have and what gold should be per ounce. And that number, that math is simple, and it's far higher than 15,000 an ounce. But are we going to see that, or are we going to see negotiated settlements price? Oh, you know what I mean? And that's where I think that's where we're going to wind up politically. I think that's a number that everybody can live with.
That's an interesting point. All right. So final question about gold, and I'll let you go, Tom. Studies have shown that millennials and Gen Z's favorite asset class right now is still stocks, not Bitcoin, not gold, not anything else, but the stock markets. What would you say to a young person who has no exposure to gold, that gold eventually is going to reach $15,000 and it is the right investment for that person? Somebody in their mid-20s, early 20s, maybe even late teens.
Well, they've lived under in their entire lives during a U.S. Treasury bull market and for all intents and purposes, a massive U.S. equity bull market. Nothing lasts forever, and a massive gold bear market, really, relative to purchasing power, relative to addressable market and all the things I just talked about. I'm not saying that gold has done badly, because it hasn't, but it has not, certainly hasn't kept up properly over the last 10 or 15 years since the 2008 financial crisis. So up until 2008, gold was doing its job just fine. And then the financial system broke, and they've been patching it together ever since. What I would tell you is that nothing lasts forever, and that you're going to have to rethink everything you've learned in your life. I make the point all the time that we have an entire 2 generations of bond traders that have never traded a real bear market in U.S. equities, that we have men who are about to retire, who entered the bond trading business during the Volcker peak in rates in 1980, who are now approaching retirement and have never traded in a bond bear market. Do you think their imprinting is prepared mentally, that they are prepared for a bond bear market? No, they're not. And so the same kind of shift in perspective is going to occur with younger generations. And I think a lot of people are actually having this problem right now of thinking that the Federal Reserve can't raise interest rates much higher. I think they're wrong. I think the Fed's going to 6%. Okay. And I have reasons why I think that, and I don't think we want to get into those today, but I firmly believe that the Fed's going to go a minimum 4.5%, probably 6%. Is anybody really handicapping that right now? No. Is it really percolating through anybody's consciousness? No. So markets are positioned for these things, but are they going to be positioned for the collapse of a U.S. equity market after a blow off top?
I would be irresponsible to end this conversation without addressing that, because that was a major cliffhanger and a major bombshell. I told you I'd let you go, but no, let's talk about that right now.
I just opened up a whole can of Pandora's box.
Let's just talk about that, and then we'll close the conversation. Sure, that's a very interesting point, Tom. You are a contrarian in that sense, because a lot of people I talk to have told me that, in fact, the Fed might likely pivot, either by the end of this year or next year, they're going to start not only just stop raising rates, but cut rates. Another argument is that we have too much debt, Tom. We can't afford interest rates at 4 to 6%. The Treasury will be bankrupt just on interest rates alone, or interest expenses rather, right?
No, only new debt. It means that Congress can't deficit spend any farther. Like we just spent 15 years issuing debt at nearly 0%. Our cost to carry is as a percentage of GDP is low as it's less than 2%. It's less than half of what it was during World War II. It's less than half of what it was during the Volcker years. Like everybody, like you can't just like, oh, we raise interest rates 1% and they add $300 billion to the budget. No, you don't. You don't add anything to the budget until you start issuing new debt in order to pay for today's programs. What they're screaming about in Congress right now is that the Fed's raising interest rates because the Democrats want to spend another $8 trillion we don't have, $10 trillion we don't have. We don't have time for me to go into the hour and a half about my theory of Davos and how they're trying to destroy the United States and everything else. I don't want to even go into that thing. What I want to get into, what I want to say is, I believe that if the Federal Reserve is done being the central bank of the world, which it has been since 2009, bailing out the entire world every time somebody's banks get into trouble overseas, Europe, Japan, this one, that one, whatever, the Fed comes in there and bails them out. But the Fed was being run by globalists who absolutely were willing to do that job. Jerome Powell is not that guy. He hasn't been that guy. He's only ever been forced to, under extreme circumstances like COVID and breaking the entire world economy and the CARES Act, to have to monetize that level of debt. He started tightening last year, overseas dollar markets, over a year ago. But he couldn't do it politically because it would have shocked markets. But he raised the reverse repo rate, payout rate by 5 basis points over the Fed funds rate. And that pulled $1.7 trillion in base money out of overseas capital markets. Mm-hmm. And they've been screaming about this ever since. And now he's raising rates aggressively. Most of the people who will tell you that who are saying, oh, the Fed will pivot next year, these are the same people in January were telling you that the Fed couldn't raise to 1% without breaking the markets. Guess what? We're at 2.25. We're about to go to 2.75 or 3. And these people want to then turn around and say, well, when the Fed pivots at 3.5, that I'll be right. Like, you were wrong a year ago. Maybe you should really up your thesis here. Maybe the Fed is raising interest rates for different reasons than you think is actually happening. And that's the key. The Fed always gets blamed. I'll say one last thing real quick.
Please, no, please.
Martin Armstrong makes the point all the time. He says, look, the Fed always gets blamed for, all of our monetary ills, but you have to also address Congress and the fiscal side of things. Congress spends money it doesn't have and then forces and effectively blackmails the Fed into having to monetize the debt, or force that blackmail onto the rest of the world to buy that debt. Well, what if no one overseas wants to buy the debt anymore and the Fed doesn't want to monetize it anymore? What if the commercial banks here in the United States don't want to play this shell game anymore? What if that system is no longer to their advantage? This is a question that very few people have actually asked themselves and then said, okay, if that's the case, what does that look like? Does that look like today? Because to me, that's what it looks like. That's why I am such a contrarian on these things. That's why I don't want to discuss capital markets in terms of the numbers, or anything else. These are all highly politicized at this point. And if you ignore the political angle on these things and you ignore the political imperatives of whose bailiwick is getting attacked and whose ox is being gored and whose potential power is going to be lost, then you're not actually addressing the markets, because we don't have free, fair capital markets. We have captured markets that look like capital markets. But I think there are still forces within our political and economic infrastructure that want capital markets to return. But that is going to be messy, and it may take a massive global recession and much higher interest rates to get that done, to remove certain bad actors from the landscape, from the game board, as it were. That's why I think the Fed can go to 4.5 or should go to 4.5 or 6%. It is effectively to stop Congress from paying from spending money it doesn't have, get its fiscal house in order, and pull back on the U.S. dollar as the world's reserve currency, because the rest of the world is walking away from it. So how do you do that and not figure out a way to sop up the dollars? You have to raise interest rates.
Interesting. I'm glad you opened that can of worms. That was a very interesting end to the segment. Let's have you back on, and
I hope you enjoyed it.
Elaborate more about your thesis about central banks. That was interesting. Tom, thank you for coming on Kitco today with your first time, and hopefully not your last. Thank you.
I appreciate it, David. Have a good day. Enjoy.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.